Open to your material.
All right. Sorry for coming in a bit late. Tonight, we are moving to a new topic. Topic is option theory and valuation. Deliberately, I'm going to try to moderate the speed of the lecture, because this topic may be coming to some of us for the first time. Given that it's a new topic to some of us, we are likely to come across something for the first time in terms of knowledge. So deliberately, I will try to moderate the speed of the lecture. The second point is, if you watch the last two diets, examiner was looking at this topic. If you check last two diets, the compulsory question was on option theory. What am I trying to stress is that you are going to be doing yourself a lot of favor if you can try to listen to the explanation and you are able to understand it. It's not a difficult topic.
Hello, sir. Good evening, sir.
Yeah, good evening.
Sorry, sir. Your audio just went off before when you barely started. So I don't know if you can just, I don't know. Your audio went off before.
Okay, the
Sorry.
audio went off at some point.
Yes.
Maybe it's network.
Yes, sir.
But please mute. All right. Let us go to this topic. Option theory and valuation. The first point. What is option? Option can be defined as the right to buy or sell an underlying asset at a pre-specified price within a specified future period. You can define option as the right to buy an asset or the right to sell an asset at a predetermined price for a certain length of time. The option market has emerged in contemporary times. We have the option market. Just as you have the stock market. The stock market is a market where you can buy and sell stock. You have the currency market. The currency market is a market where you can buy foreign currency or sell foreign currency. We now have a new market, an emerging market, financial market, the option market. At this market, you can buy or sell, you can obtain a right. At this market, you can obtain a right to buy or sell an underlying asset. This asset, the underlying asset, could be stock or bond or currencies or commodities or various kinds of financial indexes. Please note that the underlying assets could be shares, stock, bond, foreign currency, commodities, and other various kind of financial indexes. There are two classes of options. We have defined option: the right to buy or the right to sell. That means it's a right, not an obligation. You are obtaining a right to buy an asset, or you are obtaining a right to sell an asset. Classes of options. There are two classes of option. One is the call option. The other is the put option. The call option. This is the right to buy an asset. The call option. This is the right to buy an asset at a pre-specified price. So if you are talking of call option, the call option gives the holder, the option holder, the right to buy an asset at a specified price within a specified period of time or at a particular date. So you can obtain a right to buy an asset. In that case, you are talking of call option. Number two, the put option. This is the right to sell an asset. This is the right to sell an asset at a pre-specified price. Investor can obtain a right to buy or obtain a right to sell So your voice has gone faint. Maybe it's network. Or maybe I'm tired.
It's their network. You're sounding
We
fine.
are hearing you clearly. Maybe it's their network.
Okay.
Let the person log out and log in again.
In our material, right to sell, put is right to see. It's an error. It is right to sell, not right to see. What are you saying? All right. Aisha, others say they can hear me. So please look at your device and your network. Let's go on. You can obtain a right to buy an asset. In that case, you are talking of call option. Or you can obtain a right to sell an asset. In that case, you are talking of put option. Next. Option premium. The option contract involves the payment of a premium, whether or not the right is exercised. What is option premium? Option premium is the amount paid by the option buyer and received by the option seller. Option premium. This is the amount paid by the option buyer and received by the option seller. So you are going to pay so as to obtain the right to buy or the right to sell. This premium must be paid whether or not the right is exercised. This premium must be paid whether or not the right is exercised. And this premium is not refundable. And this premium is not refundable. All right. Please note that. Let us go to the terminologies associated with option. One is the option writer. The option writer is the seller. The option market. The option market is the option writer. That is the seller of the option. The option holder is the buyer of the option. Exercise price. This is the predetermined price at which an asset may be bought or sold. Exercise price. The exercise price is the predetermined price at which the assets may be bought or sold. The option premium. We have explained this. This is the amount of money an option buyer pays and the option seller receives to engage in option transaction. The option premium is the market price of the option. The option premium is the market price the market price of the option. This premium must be paid whether or not the right is exercised. All right. We have defined options. We have explained the types of options. We have explained some terminologies associated with option. Our next discussion: American versus European option. American versus European option. What is American option contract? How is it different from European option contracts? American option contracts can be exercised at any time from the initiation of the option contracts up to the maturity of the contracts. American option contracts. These are contracts. These are option contracts that can be exercised at any time from the commencement of the option contracts up to the maturity of the option contracts. That is American option contracts. For European option contracts, this can only be exercised at maturity of the contract. This can only be exercised at maturity of the contract. Please note the difference. Next. Yes, Mustafa.
Please say it again. Please say it again. American.
I can't hear you, ma'am.
Please say it again. American option something.
American option contracts.
Contracts, yes.
These are contracts that can be exercised at any time from the commencement of the option contracts up to the maturity of the contract. For European option contracts, it can only be exercised at maturity of the contract. I will still illustrate with the example, don't worry. Next, the concept of moneyness of option. Item number 6 here. The concept of moneyness of option. Moneyness of options simply means that, or simply explain whether the option is profitable or not profitable. Moneyness of option is to explain or is to determine whether the option contract is profitable or not profitable. Moneyness refers to whether the option is in the money or at the money or out of the money. Let us explain in the money. In the money simply means that the option contract is profitable. In the money simply means that the option contract is profitable. Hence, the option holder can exercise his rights to buy or to sell. I will take that again. In the money means that the option contract is profitable. Hence, the option holder can exercise his right to buy or his right to sell. That is in the money. At the money means that the option contract is at break-even point. At the money means that the option contract is at break-even point. At this point, the option holder is at liberty whether to exercise his rights or not. Number 3, out of the money. Out of the money simply means that the option contract is not profitable. Out of the money simply means that the option contract is not profitable. Hence, the option holder should not exercise his right to buy or his right to sell. The option holder should right to sell. All right. Our next discussion, option payoff values. Option payoff. What is option payoff? How do we calculate option payoff? Option payoff is the value of the option at maturity. Option payoff. This is the value of the option at maturity. At maturity, a call option is worth 0 or the differences between the asset price at maturity and the exercise price. Please look at that word. At expiration, at maturity, a call option is worth either 0 or the differences between the underlying asset price at maturity and the exercise price, which Whichever is greater. Whichever is greater. Look at this, please. Call option at maturity is equal to maximum of 0, or you have comma here, ST minus E. This is the equation for call option payoff. Look at that equation very well. Where CT, value of the call option at maturity, is equal to max bracket 0, comma, XT. Your XT is the value of the asset at maturity. Your capital letter E is the exercise price. We are going to demonstrate this shortly with illustration. That is call option payoff. This is call option payoff. Put option at maturity. A put option is what? 0, or the differences between the exercise price and the asset price at maturity, whichever is greater. Look at the equation.
Can you take the put option at maturity again, please?
Now look at this. Look at your screen, please. At maturity, a put option is worth 0, or the differences between the exercise price and the underlying asset price, whichever is greater. The above analysis is also called option intrinsic. This should be T. Option intrinsic value. The above analysis is also known as the option intrinsic value. You may be asked to calculate the intrinsic value of the option. That is the value of the option at maturity. Now let us illustrate what we have explained so far. So far. Let me create space here. We need to illustrate this. All right. Let me take my pen. Please, just 1 minute. Please, just 1 minute. I'm trying to enable my device, my digital device. so that we can demonstrate this with illustration. All right, let's go on. We said option. This is the right to buy or sell an asset at a predetermined price within a specified period or at a particular future date. Let us illustrate this. Assuming you are expecting your December bonus. You are expecting bonus in December. You are expecting, like say, 500,000 bonus in December. And your plan is you are going to use this bonus in December to buy First Bank shares. Your plan is to use your December bonus to buy First Bank shares. Assuming you are buying First Bank share today, we know the price of First Bank shares at the stock market. But you are going to get the money in December, say December 15. You are going to get 500 million, 500,000 December bonus. And your plan is to use this money to buy First Bank shares. You can approach option market today. Today is 12th August 2025. You can approach the option market today to obtain a right to be able to buy First Bank shares in 5 months' time, December. You are obtaining a right to buy First Bank shares today. You obtain a right to buy First Bank shares at a price agreed today, assuming the price is 100 naira per share. You have agreed to buy First Bank shares at 100 naira at a future specified date. That future specified date is 12 December 2025. This price you obtain today is called exercise price, or you can call it strike price. That is the predetermined price at which you are going to buy First Bank shares at a future specified date. You enter into the contract today. You obtain a right to buy, right to buy First Bank shares, First Bank shares at a price agreed today. That price agreed today is called exercise price. You are not going to wait until 12th December. Assuming that on getting to 12th December, First Bank shares at 1st December 2025, First Bank shares are trading at 150 or 75 naira. Assuming First Bank shares are trading at 150 per share. My question to the class is, will you exercise your right to buy or not? If on 12th December, First Bank shares are selling for 150 naira per share. My question to this class is, will you exercise your rights to buy or not? We have to speak to it, or you send in your response via chat.
I will exercise my right to.
I can't hear you, sir. And please indicate by raising up your hand. Let me check the responses. Aisha said, yes, I will exercise my right at 150. That is brilliant. Ufama said no. Okay, that is wrong. Finance Minister said yes. The appropriate response is yes. You have obtained a right to buy First Bank shares at 100 naira. In December, on getting to December, First Bank shares are trading for 150. You are going to pay 100 to buy what's worth 150. Then it is profitable to exercise your right. Let me take this to call-off matrix. Look at this. The appropriate response is yes. If you pick no, that means you have not gotten the principle. If you are thinking no, that means you have not gotten the principle. Please hold on, Mustafa. Look at it. You have obtained a right to buy First Bank shares. That means that is a call option. Call option. Call option payoff. The formula is CT is equal to max bracket O XT minus E, where your XT is asset price at maturity. Look at maturity. Maturity is 12th of December. The asset is First Bank shares. At 12th December, First Bank shares is 150 naira. That is at maturity. This is 150. Your E, exercise price. The exercise price is the price agreed now, 100. Look at it, 100. If you come back to this formula, maximum of 0 or 150 minus 100. The max of 0 or 50. You have a choice either to accept 0 amount or to accept 50 naira per share. As a rational investor, you are going to accept 50 naira. That means this option contract is in the money. That means this contract is in the money. Look at it. Look at it. You can say the call option contract is in the money. It is profitable for the option holder to exercise his rights and buy First Bank shares. He's going to buy at 100 naira because he has obtained a right to buy at 100 naira. He can now sell at 150 because at the stock market, the shares are trading for 150. By doing this, the option holder will make a profit of 50 naira. Yes, Mustafa, you can ask your question now. I do. Yes, any question? Any question? All right. If there's no question, we can continue. Please, 1 minute. Let's continue. Let's continue the class. Now, please note, to obtain these rights, you are going to pay a premium. This premium is non-refundable. All right. The illustration we gave is on call option. Let us look at, okay, before I go out of this, assuming, before I go out of this, assuming in December, First Bank shares are trading at 75 naira per share. Remember, you have obtained a right to buy at 100 naira. On getting to December, First Bank shares are trading at 75 naira per share. Now the question is, will you exercise your right to buy or not? You can respond via chat, or you can call, you can raise up your hand to speak.
It is no, because it is below the share price.
Okay? It is no because it is not profitable. You have obtained a right to buy at 100 naira. That is in December. On getting to December, First Bank shares are trading at 75 naira. That means if I size my rice, I'm going to pay 100 naira for what currently was 75 naira. It is not profitable. We can demonstrate this. You can demonstrate this with the formula for call of payoff. Look at this. Call option payoff is equal to maximum of 0, ST minus E. At maturity, First Bank shares worth 75 naira. You have obtained a right to buy at 100 naira. That is the exercise price. You now put it to that equation. Maximum of 0 or 75 minus 100. Maximum of 0 or minus 25. If you exercise your right to buy, you are going to incur loss of 25 naira per share. That means it is better to settle for 0, meaning that you are going to opt out of the option contract. It's a right to buy, not an obligation. It's a right to buy at 100 naira, not an obligation to buy. For the second scenario, this contract is out of the money. For the second scenario, look at it. The option contract is out of the money. Hence, option holder should not exercise his right to buy. This illustration is on rights to buy. Any question, please? Aisha, Mustafa, Ufoma. Any question?
I was thinking the exercise price is 75. Did you change it?
No. The exercise price is 100 naira.
Okay.
At maturity,
Is there something
Bank shares are trading for 75 naira.
Is that something to help us know the difference?
What difference are you referring to now?
I'm saying when the question comes out, it's clear, it's not hidden.
It's always there now.
Okay.
Illustration we give. You obtain a right to buy First Bank shares at 100 naira today. You want to buy First Bank shares in 3 months' time. You now obtain a right to buy at 100 naira today. On getting to 3 months, examiner says First Bank shares are trading for 75 naira. That means 3 months is the maturity of the contract. It's always direct now. All right, I believe that with time, by the time we do more illustration, by the time we solve question, I want to believe that it's going to get better. All right, let me take one more illustration. Assuming, please allow me to use Aisha's name. Okay, my daughter now. Assuming Aisha has gotten some shares. Aisha has gotten some shares. You have some investments with Dangote. You have invested in Dangote shares. You have bought some shares with Dangote. That means you have investment with Dangote currently. And you are planning that in December, you plan to travel. You will be traveling in December. And I say, okay, I will require money for this traveling. My December trip, I'm going to require money for this purpose. I say, okay, I'm going to sell some of my Dangote shares to generate cash in December. You are planning to sell some of your shares in December with First Bank. Assuming you are selling today, you know the price of First Bank shares at the stock market. Assuming the investor wants to sell our shares today, we can get the price of First Bank shares at the stock market. But the investor is planning to sell in December. You can now approach the option market. You can approach the option market to obtain a right to be able to sell your shares, your Dangote shares, at a price agreed today. You are going to approach option market today. Look at it. The investor will approach option market today. Today is 12th August. To obtain a right to sell our shares in December. You are obtaining a right to sell your shares in December at a price agreed today. Assuming the investor obtained a price of 125 naira per share. You have obtained a right to sell at 125 naira per share in 5 months' time. That will take us to December. That is like December now. This price you obtain today is called exercise price. The price at which you are planning to sell your shares in December is called the exercise price. You are not going to wait until December. Now, assuming we have gotten to December, we are now in December 2025. Examiner says Dangote shares are trading for 150, okay, 120 or 180. Let me change this to 100. Examiner says Dangote shares are trading for 100 naira or 180. Now the question to the class is, will you exercise your right to sell if scenario 1 happens? Assuming First Bank shares, Dangote shares are trading for 100 naira. You have obtained a right to sell for 125. Now the shares are trading for 100 naira. The question to this class is, will you exercise your right to sell or not?
No, sir, because it's not profitable.
No. All right. The first speaker said, no, I will not exercise my right to sell because it is not profitable. Let us see response from the chat. Aisha said yes. Former said no. The appropriate answer is no. The appropriate answer is no. You have obtained a right to sell your shares for 125 naira. Wait. No, the right answer is yes. The appropriate answer is yes. You have obtained a right to sell your shares for 125 naira in December. In getting to December, First Bank shares are trading for 100 naira. If you say you are going to sell at 125, what's currently worth 100 naira? You are going to be making a profit of 25 naira. The appropriate answer is yes. You can now go and test this. The appropriate answer is yes. Got it? Put option payoff. PT is equal to maximum of 0 exercise price minus ST, where E, the exercise price, 125 naira. ST, asset price at maturity. At maturity, Dangote shares are trading for 100 naira. I can now text it. My PT is equal to maximum of 0, 125 minus 100. That will give me my PT is equal to maximum of 0 or 25. In this case, it is profitable to exercise my rights to sell. If I exercise my rights, I'm going to sell at 125 naira. What's currently worth 100 naira? In this case, the put option contracts. Look at it. You have a choice between accepting 0 amount or making a profit of 25 naira. The put option contract is in the money. Thus, investor should exercise his or her rights to sell Dangote shares. This is the appropriate response. This is the appropriate response. Yes is correct. If you are in doubt, just go and pick the option payoff. Once you have a positive sign, whichever is greater, 25 is greater than 0. So it is better to exercise my right to sell. Is that clear, please?
Hello, sir.
Yes, please.
Yeah, in this option, I just want to clarify my doubt. If at a right to purchase or to buy and the right to sell, I see the formula changing position. Exercise come first because maturity, but in the former one, maturity be minus exercise.
Yes, that is the appropriate formula.
Okay, they change position. Okay.
Yes.
Okay, thank you, sir.
This was the question. This was the question tested November 2024. Most students abandoned the question. That question won't take you 30 minutes. Just look for the exercise price. The examiner says calculate the option payoff. You are going to look for the exercise price and the asset price at maturity. Look at the second scenario. For this first scenario, the option payoff is 25. Here, the put option payoff, put option payoff is 25. Whichever is greater. Now look at the second scenario. You have obtained a right to sell your shares at 125 naira per share. This price, 125, is the exercise price. You are going to sell in December. On getting to December, Dangote shares are trading for 180 naira per share. This 180 is the asset price at maturity. Maturity is December. The asset we are referring to is Dangote shares. Now the question is, will you exercise your rights or not? Let me check. I can see one response. No, I won't. Aisha said, no, that's correct. No, Anthony, no. The appropriate answer is no. You obtain a right to sell for 125. At the stock market in December, these shares are trading for 180. Remember, it's a right to sell at 125, not an obligation to sell at 125. What do? You are going to pull out of the option contract. I will not sell at 125. You are going to opt out of the option contract. Let's go and demonstrate this. Let's demonstrate this. Second scenario. Scenario 2. Put option payoff is equal to 0 E minus XT max. My E is 125, the exercise price. My XT, stock price at maturity. At maturity, Dangote shares are trading for 180. I will not come here. Payoff, maximum of 0 or 125 minus 180. My P is equal to maximum of 0 or negative 5. Look at it. You have a choice between accepting 0 or in this case, it is better to accept 0, meaning that you are going to opt out of the option contract. You are going to opt out of the option contract. In this case, the appropriate response here is to say the put option contract is out of the money. Option holder should not exercise his rights. 5. In this case, the option payoff, the put option payoff. Payoff is 0. That means opting out of the contract. You can opt out of the contract. You cannot go and sell at the stock market price, which is 180. But remember, you are going to pay a premium to obtain the right to buy or the right to sell. All right? We have illustrated both the call option and the put option. Our next discussion is put call parity. This is 0. Our next discussion is put call parity theory. The put call parity theory. Let's go to this. This is the most fundamental parity relationship among option prices. This is the most fundamental parity relationship among option prices. This relationship shows that when certain conditions are met, these conditions are met, there is a fixed relationship between the market price of put option and the market price of call option. This relationship shows that where certain conditions are met, there is a fixed relationship between the price of a put option and the price of a call option. This fixed relationship is represented with the equation below. Wow. Please hold on. That was virus. So it's moving my system anyhow. I know what to do. No bad son. I really want to hack into my system. Let me see what I can do. Please hold. Okay. Not possible. Can you imagine? All right, let's go on. Can you imagine? My device is responding to another device. I look at the relationship. Theory. It says the equation is C plus capital letter E, then small letter e. This is exponential function raised to minus RT is equal to P plus X. Let me rewrite this for you. The equation of put call is okay, and that's what happened. Was pressing this. This is C is equal plus E this is small letter e raised to minus RT is equal to P plus X. Where your letter C represents call price, the price of a call option. Your capital letter E, that is the exercise price. Your small letter R, that is the risk-free rate. Your capital letter T, that is the time to maturity. Your P is the put price. And your X, that is the current stock price. Please, your small letter E is exponential function on your calculator. This is the equation of put call parity. This equation can be used to calculate value of a call option if value of a put option is given. This equation can be used to calculate value of a call option or price of a call option if the price of a put option is given. Alternatively, we can use this equation to calculate value of a put option if the price of a call option is given. I hope that point is clear. This equation is used for that purpose. Now, conditions for puts call parity theories. Conditions for puts call parity theory. 1. The call and the put options must be on the same underlying assets. The call and the put options must be on the same underlying assets. Condition 2. The call and the put option must have the same exercise price. The call and the put option must have the same exercise price. Number 3, the call and the put option must have the same maturity days. Next, the underlying assets must not pay dividend during the life of the option. Next, the call and the put option must be an European style option. You can only use this formula to calculate European option contracts. This formula can only be used to calculate European option contracts. That is, the contracts can only be exercised at the maturity on the maturity dates. Then the last one. The bond, that is the present value of exercise price, must be a risk-free zero coupon bond with a face value equal to the strike price of the option. These aspects, we are going to demonstrate it by calculation. Then the next thing, the black scores option pricing model. The black scores option pricing model. To calculate value of option, or to calculate the price of option. What is value of option? What is the price of the option? That is the premium paid. What is option value? What is option price? Option value and option price is the premium payable. To calculate this premium payable, there are different models that have been developed. For you to calculate the option price or the option value, we have different models that have been developed for this purpose. One of these models is Black Scholes option pricing model. One of these models is Black Scholes option pricing model. Don't mind me. My hand is touching the digital device. That's why it's responding. There's no virus. It's because I didn't even know my hand is touching that device. Now let us explain Black Scholes option pricing model. The Black Scholes option pricing model is a mathematical model that is used to determine the fair price or the theoretical value of a call or put option. I'll take that again. The Black Scholes option pricing model is a mathematical model that is used to determine the fair price or the theoretical value of a call or put option based on 5 input variables. Based on 5 input variables. The input variables are underlying asset price, time to maturity, the exercise price, the risk-free rates, and volatility. The 5 input variables needed are exercise price, underlying asset price, the time to maturity, the risk-free rates, and the volatility. If you are to value option using Blasco, if you are to value option using Blasco model, you require 5 input variables. Look at the input variables. 1, underlying asset price. This is equal to XO. To exercise price. This is denoted with capital letter E. 3, risk-free rates. This is denoted with small letter R. Four, time to maturity. This is denoted with capital letter T. And 5, volatility. In bracket, standard deviation. This is equal to Q line. Those are the 5 variables needed to value option using the Blasco model. With Blasco model, the formula for call option is if you are to use Blasco model, I want to calculate price of call option. The formula is open a bracket XO multiplied by M bracket D1, close my bracket, minus another bracket, E exponential negative RT multiplied by ND2. If you are to value put option, the formula is excise price exponential negative RT multiplied by M bracket minus D2, close your bracket, SO bracket minus D1. You can use this formula to calculate the price of a call option or put option. Your D1 and D2. D1 is equal to in bracket SO divided by E plus R plus 0.5 multiplied by standard deviation square for your D1. In this is equal to in bracket XO divided by capital letter E plus XO plus open a bracket R plus 0.5 multiplied by standard deviation square, that is volatility square. Then close your bracket, multiply by T. Denominator is standard deviation multiplied by the square root of T. So get your D1, your D2. Your D2 is equal to D1 minus Q multiplied by the square root of T. This is the formula for Blasco. We can define the variable small. Letter P, that is the price of a put option. Letter C, price of a call option. SO, current stock price. Capital letter E, the exercise price. Our D1, value of the area under a normal distribution bell shape. Your small letter R, continuously compounded risk-free rate of return. Letter T, time time to expiration. Then the standard deviation sign. The annualized deviation, standard deviation for the stock market. All right. We now look at the assumption fundamental assumption of Black School model. The Black School model was developed upon certain assumptions. The Black School model was developed upon certain assumptions. What are these assumptions? One, interest rates are constant and known. Number two, an assumption that the underlying stock does not pay dividend during the life of the option contract. An assumption that the underlying asset does not pay dividends Number next, it assumes a frictionless market. A frictionless market a market where there is no transaction cost, a market where there is no taxation, then it is assumed that the model cannot be used for American option contracts. All right. Yes. Ufoma Akubo.
Sir, can you please explain this? He said the underlying stock does not pay dividend. How? Just explain, please.
The underlying stock does not pay dividends during the life of the option contract. For example, you are obtaining a right to buy First Bank shares in 3 months' time. You go into option contracts. You are obtaining a right to buy First Bank shares in 3 months' time. You now pay the subscription. Now, within these 3 months, First Bank shares must not pay you dividends. If you are to value First Bank, if you are to value the options using Blasco, it is assumed that the underlying assets will not pay dividends during the life of the option contract. That is the assumption. All right. Let us round up with the explanation on the Greeks. The Greeks measures the sensitivity of option value or option price with respect to changes in the input variables. The Greeks measures the sensitivity of option price or option value to changes in any of the input variables. What are these input variables? We have 5. The Greek measures sensitivity of option price or option value to a change in any of the input variables. We have type of Greeks. We have data. We have types of Greeks. One is data. One is data. What is data? Data measures the sensitivity of option price to a change in underlying asset price. Data measures the sensitivity of option price to a change in asset price. You can calculate your data as change in option price divided by change in the underlying asset price. That is how to calculate data. Notes: with Blasco model, data can be approximated as follows. Data of a call option is N bracket D1. Data of a put option is ND1 minus 1. Delta of a put option, ND1 minus 1. And delta of an asset is 1. Please, you are going to memorize this. Delta of call, delta of put, delta of an asset. Delta of an asset is equal to 1. An asset could be stock, shares, bond, foreign currency. Damilola, yes.
Sir, what does this N stand for? What does it stand for? The N.
What does
N, the N.
Please, I can't hear your question, Damilola. What does what stand for?
N.
The N in the formula, this is what she means, sir. N in the formula, you said the delta of a call option is equal to capital letter N into bracket D1. So she's asking of that N, the capital N.
Okay. The capital N and the D1. That capital N is the normal distribution log. Normal distribution 1. That N implies normal distribution. We can't calculate anything today. I can only try to finish the explanation. So, Dami, don't worry. If you look at this formula, it's there also. Look at this formula. Look at ND1. It's in the formula now. That N stands for normal distribution. Still on data, we have data neutral hedging. Data is also used as an hedging tool. You can use data to protect your investment value against fluctuation. Data is also used as an hedging tool. A data neutral position is one whose value does not change. A data neutral position is one whose value will not change, does not change in response to changes in the value of the underlying assets. A delta neutral position is one whose value will not change in response to change in the value of the underlying assets. The objective of a delta neutral portfolio is to combine position in assets with a position in option. The objective of a delta neutral portfolio is to combine a position in assets with a position in option so that the value of the portfolio does not change. So you are going to work towards a delta neutral position. Let's round up this. Other Greeks, we have gamma. Gamma measures the amount by which delta value changes. Gamma measures the amount by which delta value changes as the price of the underlying asset changes. Gamma measures the amount by which delta value changes as a result of change in the price of the underlying asset. Gamma is calculated as change in price Gamma is calculated as change in delta value over change in the underlying asset price. Change in delta value as a result of change in underlying asset price. Gamma is positive for both call and put option. Gamma is positive for both call and put option. Next, we have theta. Theta measures change in option price due to change in time to maturity. Theta measures change in option price as a result of change in time to maturity. Your theta is calculated as change in option price divided by change in time to maturity. Please remember, option price has two components. The option value can be divided into two components. The first one is the intrinsic value. The intrinsic value of the option. And the time value. That option value is made up of two components, the intrinsic value and the time value. Number 4 or 3, we have real. RHO. This measures the sensitivity of option price to a change in risk-free rates. Real measures the sensitivity of option value to a change in risk-free rates. Real is positive for call and negative for puts. Then the last one is Vega. Vega measures the change in option price for a given change in algorithm. Change in option price for a given change in the volatility of the underlying asset. In other words, Vega measures change in option price if there is a change in volatility of the underlying asset. These are the 5 Greeks. Delta, gamma, theta, rho, and Vega. We are done with the introductory explanation. It is obvious that we can't take any class now. All right. May God give us a better understanding, and may God bless our efforts. Any question, please? Otherwise, I will be checking out of the classroom.